Okay, we can start. Mary and Mugutan, are you ready?
Yeah,
Yes.
bro.
Okay.
Can we start?
Okay, we start. Assalamualaikum and good evening to Dr. Masuk and all of my fellow classmates. My name is Faruddin bin Hamdan. I'm a part-time MBA student, and today, me and my Group 1, will be presenting an infographic about cash dividends. For now, I'll pass to Mary.
Okay, thank you, Farhan. And a very good afternoon to our lecturer and also our classmate. And today we'll be presenting about a cash dividend, and I will be clarifying in a short term whereby the cash dividend method is a way for a company to distribute its profit to shareholder by paying them directly in a cash based or in a number of like shares they own. So next followed by the key feature. Key feature is divided into few parts. Which is first will come by paid in cash, whereby the shareholder receive money directly, and second followed by from company profit, which is declared from retained earnings, and if followed by per share basis, which is paid according to the number of shares owned, and also followed by require board approval, must be officially declared by the company directors. And also if let's say reduce company cash means, which means company reduce company cash will be company cash balance decrease after the payment. So the next will be regular or on time, whereby can be paid quarterly, annually, or as special dividend. And followed by taxable income, which we describe as usually subjected to tax depending on the country rules. And also like a benefit shareholders directly means, which is provide immediately return to the investor. So and that's all from me. I will pass it to Farhan. Thank you.
Thank you, Mary. Now I will present about the advantages and disadvantages of cash dividends. For the first advantage, it provides immediate income to shareholders. The second advantage is to attract income-seeking investors, as they know that the company is able to provide them with immediate income. So these investors are now more attracted to invest on the share or bonds, and then it also indicates a good financial health for the company, as they are able to provide immediate income to all of their investors on time. As for the disadvantages, because they are bound to provide the immediate income to their investors in certain amount of period of time, they are unable to sometimes their funds are sometimes reduced to a point that cannot even invest in other projects or other part of their operations. The next disadvantage is the investor continuity expectation, because the investor are investing in the hopes of getting their income on time. Company are now forced to make sure that the dividend are paid on time. If not, the investors will pull out of the investment program. And the final disadvantage is possible limited growth opportunity indicator. Now I pass to Mugundan. Thank you.
Yeah, I'm going to present about the real world example of cash dividend is I'm chosen Maybank. Okay, in 2023, Maybank paid a cash dividend of 30 cents per share. The bank the bank is known of a very high dividend payout. The ratio usually the around as 70 to 80% of its yearly profits. This shows that the company has strong cash flow and is committed to rewarding shareholders consistently. Maybanks regularly their cash dividends also build investor confidence and reflect its stable financial performance, making it one of the top dividend paying by the companies in our Malaysia. Yeah, that's all from us. Thank you, sir.
Thank you, Doctor.
Thank
Thank you,
you.
thank you everyone. With the short notice, you have prepared a good infographic as well as you presented well, and things are very clear why there is a cash dividend, why not, and there is a real-time example as well. Thank you, group. Thank you so much for your presentation.
Okay, thank you,
And
Doctor.
Thank you,
and
doctor.
and the design would be like that. After this, I will discuss some of the issue. I will repeat the advantages and disadvantages and why cash dividend like that. Then we will proceed to the another group. So no worry. If we do not have time, it will be continued in the next class. Maybe those who are
Okay,
Sure,
physical,
doctor.
all right,
maybe
thank you,
maybe
Doctor.
Okay.
yeah, yeah. So that would be like that. Okay. So the question is. We are talking about the discussion is all about payout, like dividend. Okay. Sometimes it is called payout, sometimes it is called dividend policy. So the chapter suggests dividend policy. So before starting that one, although the group already mentioned that there is a cash dividend or something. So what is actually the dividend? If you consider that dividend is not fully the earnings, company have their earnings, but the portion of earnings is ready or distributed to the shareholder, that is actually the dividend. Company may have more earnings, but if they actually retain, suppose if it is 100, then 70% is retained and 30% is distributed. That means that 30% is regarded as considered as the dividend. Why this chapter, dividend policy? Because if you consider financial management, then in finance, we know there are some financial decisions. The raising of fund, that means sourcing of fund, investment of fund, and then asset management. So this is under the asset management decision, the third one. That means how you are going to satisfy your shareholders, how you are finding new sources. Because if you do not distribute any dividend to the shareholder, then you can reinvest this one. Because if you need to expand its new branches, new product, new services, then you need fund. What is the usual sources? We take it from outside, like you see from bank or other, you see from the capital market. So instead of that one, company may reconsider it from their own sources, from their retained earnings, provident fund or something, so they can invest it. Yes, obviously, and agree with this group that if a particular company provides a regular dividend, that indicates that company has stable earnings. So that means they are able to provide a dividend. So that signifies the ability of the company. And this is very good because if the company do not give any dividend, it is okay, because in last classes in cost of capital we have discussed that uh, stock is is a particular sources of capital that do not you see compel you to give dividend every year, because in 2 3 years you may not give particular dividend. So that is the convenience, that is the flexibility you have as a company. But if it is bond, if it is bank loan, then you must provide interest, otherwise it would be like uh, bad debt. Okay, so it would be on list of the defaulter or something like that. But in investor will not, particularly the stockholder will not complain. Okay, they may have their dissatisfaction, but they can sell it to the market and they can buy other share, or they can go for a bond or other particular security. But there is an option. So that is why there is a less risk and company can use this dividend. Okay. So if they do not distribute dividend, but they can still can make up this one with increased dividend in the next years. And we by this year, they can use this fund for their expansion, for their growth. So yes, if I am a company, if you are owner, so if you need to pay your dividend regularly at a certain rate, then this is the risk, because every year may not be the same cash flow you are having. So that is the thing. So yes, we understand that dividend policy there are different, you see, what we can say, that different policy has different impact on the shareholders value. You see why it is important, and why it is important for the companies, because in the very first class we promised that our target is to maximize shareholders wealth, right? Anything that increases shareholders wealth, we must go for. So this dividend policy is like that. You can find in the market, if you have any practical exposure in the market, if you have an investment, you can find that whenever there is a dividend distribution declaration is coming, or declaration is already declared, then you will find that share price go up. After the allocation or distribution of the dividend, it go down. So that means the dividend has some sort of signal in the market. That is why there is a theory, it is called signaling theory. Okay. So if I share this one, if since we are just uh, explaining things from here, just a minute. I need to share this one screen first. Maybe the screen. So I'm coming to the another presentation, but just let me give some overview. So it indicates there is a, can you see it? Can you read it? Can you see it?
Yes, clear.
Okay. So I'm talking about this theory. So there is a tax preference theory, there is a irrelevant theory, and birds and hand theory. There is another theory that is called signaling theory. That means whenever a particular company provides a regular dividend, whether it is a cash, whether it is a stock repurchase, whether whatever it is, it indicates, it signals that company has sufficient cash, company is running smoothly. So this is the positive signal went to the market, and this is helpful for the demand of the particular share or something like that. And also, I mentioned that if dividend is declared, price is go up. You see, that is why uh, there is a theory. It is called a relevant theory. But there are some school of thought. They consider dividend is not relevant because there is a cash dividend and there is a stock dividend, and you can earn your money by getting, that is holding share until 1 year, and you can have the cash dividend or other dividend. But you will find some of the other investor, they do not want to wait until the year or years, like 2 years, 3 years, like that. So they will just buy today, they will hold for 3 days, and after 3 days they will sell it to the market, and that is why they can have the capital gain. So that is why the opposite thought, opposite, that is scholar, they actually have their strong argument that dividend is totally irrelevant. They believe that people do not wait until the payout or dividend coming, so they will buy and rebuy. They will buy and sell the share, okay, and they will have their uh, desired dividend or something. So that is why this is the opposite thought of the other scholar. But still, we can see from the market experience that yes, dividend has significant impact of the company's growth, even their demand and everything. So yes, that is why there are some people, they believe that birds in hand theory, in a sense that the bird we have today, that means in my hand, that is worth more than the 100 bird on the bush, on the tree. So that means that that bird we cannot have. We cannot catch it. So the bird we have. That means if we get 10%, if cash dividend is only 10% or 10 ringgit, then there are some investors they prefer, because in our investment, okay, so stop presenting. Okay. So in our investment, it is most likely that we have different sort of clientele group. You see at the end of this lecture, sorry, maybe, okay, there are some different clients. You see, your investor may be your grandma, investor may be a particular student, maybe army professionals, maybe they are service holder. So that is why they are, so maybe institutional investors like banks, like you see the other financial organization are like that. So their expectations are not the same. Some people believe that they need cash dividend. Some people they believe that they need actually the stock dividend. Okay. So that means if we have two, then we can get another one as there as a dividend. Not as a right. right share is different, bonus share is different. So this is actually the share dividend we are talking about. Okay. So now can anyone and the group can explain about the share dividend? We already have known about cash dividend. Now can you explain? Then I can explain and I can proceed. The stock dividend, the second one, share dividend. Anyone? So you don't have your infographic groups? Who are the group they have taken this one? No one?
Good afternoon, doctor. Yes, I
Yes.
think my group can find
Okay. So did you upload it?
uploaded already.
Okay. So can you just share it? Is it possible?
Okay.
Okay. Then we can. So I think yes, I already. You need to just press the share and you can share it.
Doctor, can I ask one question?
Yeah. Yeah. Please. Please.
About the signal theory just now, right? You
Hmm.
mentioned that because if they can provide the dividend on time and all that, it signals that they have good financial health, as our group present earlier.
Hmm.
But that is only for dividend and other types of like shares, right? Because if the firm provides CP, we cannot like say that the company has strong financial health, right? Because usually CP is for them to need the immediate cash to pay for their liabilities, current liabilities, and all that, right?
Yes. Yes.
So this means you cannot put use for CP specific.
Okay. So then what is the question? We understand the yes. So
So basically, the question is, does signal theory does commercial paper also be like, can we say that commercial paper works under signaling theory, or we cannot use CP in this case?
mm, maybe a particular theory has many explanations for it can be used for different cases also. You see the game theory, it is used in different purpose of the life event, economics and different one. But what I wanted to say that signaling theories when there is a signal you can give but your customer. Yes, it could be for other share, bond or anything. Because you see, in case of bond, it is not applicable in that way because there is a fixed interest rate. But
Mm,
here you are paying dividend, whether it is a cash or in form of you see the stock, it will give a particular signal to your clientele group that
mm,
you are serious about them and you
mm,
have sufficient cash. And because why you will pay dividend when you have sufficient cash? Then if you do not have exactly like you that if you do not have sufficient liquid money, in that case you will not provide cash, you will give to the other option like stock dividend.
mm,
If you have sufficient do not have sufficient cash, you will go on the other option. But if you have liquid money,
mm,
sufficient money to distribute, then only you can go with the cash dividend. So that is why
mm,
signaling theory gives it. So if you can pay cash, then it indicates that you have regular cash. So that is also a
mm,
signal. But stock dividend is also included that the company is able to provide dividend in terms of cash or uh, stock is equivalent almost. Yeah.
So meaning we can assume that if the company is able to provide CP, it doesn't signal that it have good financial health as well.
CP, that means CP.
Yeah, commercial paper.
Oh, commercial paper.
Yeah.
Commercial paper is different. Commercial paper is different from this stock. Commercial paper is like a security, like stock, bond. Like
Mm,
in
mm,
case of banking, they use commercial paper or individual
mm.
any sort of credit. So I think that is different.
I see. So we cannot apply this theory lah, basically.
Maybe there are some portion that can be
Mm,
applied, but not
I see.
exactly like this. Commercial paper is different.
All right, understand. Thank you, doctor.
Okay, okay, okay. So yes, Emily, yeah.
Yeah. Okay. Good afternoon all. About this definition of dividends, my group mate, Mr. Majid, he will explain about it. Mr. Majid, please.
Yes, good afternoon, Doctor.
Good
Thank you,
afternoon.
Emily. Thank you.
Yeah, yeah,
Actually, the share dividends is the payment made by the company to its shareholders in the form of additional shares of its stock, rather than in the cash. It is distribution of portion of the company's earning, and it's typically used to reward shareholders while conserving the company's cash reserve. And actually, we have to ask why firms share dividends. Number one, increase the number of shares outstanding. That's mean the company issue more shares into the market, which may enhance liquidity. Number two, convert part of returns earning to paid in capital. This means the strength company financial position by relocating internal funds. Number three, minimize cash distribution. The company returns its cash instead of spending it on the dividends. Finally, number four, lack of liquid cash. Sometimes company doesn't have enough cash to pay dividend, so it offers shares instead. Thank you, Emily.
Thank you, Majid. So it's important to understand share dividend because it's essential for investors who seeking financial stability. They not only provide a regular income but also indicate the company profitability. By investing in dividend-paying stock, shareholders also can build their wealth over time while enjoying the benefits of compounding this return. So I talk about a little bit of the advantage of the share dividend. So the company stay financially strong. Therefore, it's good for the shareholder in long term. Then next, okay, shareholder no need to pay tax. In many countries also, they doesn't need to pay tax by while enjoying this share dividend. Then third will be it signal the confidence from the company for future growth. So more investor will be more confident on the company. Then last but not least, so more potential gains in the future can be good for a long-term investor. So just this is just a fact not fact just a finding that 70% of the company pay dividends. So dividends represent a portion of a company profit distributed to the shareholder, providing a steady income stream while also reflecting the company financial health and also the performance over the time. Next, I would like to pass to Mr. Elham to enlighten us about some disadvantage of a share dividend. Elham, please. Is Elham here?
Yes, good afternoon.
Okay.
After the advantages, I will focus on the main disadvantages that investors should be aware of. So we can see share dividends can also create challenges. First, dilution of share value. When a company issues a share a dividend, the total number of shares increases. This means the value of each individual share usually becomes smaller, even though shareholders receive more shares. The total value of what they own doesn't actually increase. This is a disadvantage because the share price may look weaker, and the investors may feel their ownership is being diluted. Second, no immediate cash benefit to shareholders. Unlike cash dividends, share dividends don't give shareholders any money. They only receive more shares instead of cash. This can be a disadvantage for investors who depend on dividends as a regular income source. Third, possible negative market interpretation. Sometimes the market sees share dividends as a sign that the company might not have enough cash available. Investors may think the company is facing liquidity issues or financial pressure. This negative interpretation can reduce investor confidence and may affect the company's stock price. Number four, lower market price and confusion. Share dividends increase the number of shares in the market, which usually leads to a lower market price per share. Even though the total value of the company stays the same, the lower price can make the company appear weaker. It can also create confusion for investors when calculating things like earnings per share or comparing stock performance before and after the share dividend. Thank you.
Okay, thank you,
Thank
Ilham.
you.
So next, Darren. Darren, please. Your real case you may
Uh,
share with us.
I think this is under Dina's part.
Okay, sorry, Dina, please.
So I'm happy to see you active. Yes, actually, this was the purpose.
Hi, Dina, are you here?
If she is not available, okay, no issue. So you can finish also. So you also got the insight from here.
Okay. So our real case, Dhabi, which is a major Malaysian multinational conglomerate with history long ago, 19 since 19. It's a Malaysia's largest company, operate across the Asia Pac region, and now it underwent a major restructuring. So, okay, the current Sun Dhabi often referred to Sun focus on two primary business, industrial division, motor division, and also UMW division.
Okay.
Okay,
This
Darren,
is
you
my
may
part.
continue.
All right. The reason why we chose Sun Dhabi was because Sun Dhabi operated in Malaysia since the colonial times.
Okay.
During the colonial times, they were focused more on the what do you call that, resource extraction, raw resources and such. But I believe also Sun Dhabi has accrued a lot of their experience from back in those days. Evidently, after COVID, you can see right during COVID in the 2018 revenue was around 33 billion, but after that you can see after COVID 2024 their revenue is up to 67 billion. That is almost double already. So I believe that Sun Dhabi, will utilize their experience, and of course they will pivot to a more what do you call that? I think it's a streamline operation. Okay, next slide, please. So you can see that they have actually done a few strategic evolution. Okay, first they have decided to what do you call that? Consolidate by acquiring UMW Holdings for 5.8 billion. So this is basically they just want to solidify their dominance in the Malaysian automotive industry. Okay, because of course we know Malaysia is a very car-centric society. Who is going to cycle to work in the middle of the afternoon or early morning? We will use car one. And then after that, they have decided to diversify their portfolio. Okay, because they decided to divest Ramsay Sime Darby Health Center. Okay, so they wanted to pivot away from their non-core asset. All right, and then furthermore, they would want to future-proof their what do you call that? I think their strategy by what do you call that? I think they wanted to focus more on the electric vehicles. Okay, so they decided to spearhead the launch of BYD in Malaysia and Singapore. So basically they are not just selling cars, they just want to capture the next wave of growth in mobility lah. Okay, so moving on, shareholder value creation. So the dividend yield is around 6.7%. Okay, if you, I think this is double the what do you call that? Um, what is that? You add in invest in the bank one 3 point something percent. Fixed D is 3 point how many percent again? What is
Interest.
the interest?
They
How
two
much
point
is it?
It's
something
3 to
only.
4% rate in Malaysia right now,
Two
3
to
to 4%. Yeah.
3 to 4%, right? But this one dividend yield is 6.7%. Okay, so I feel it's also quite nice to invest in it lah. And then after that, secondly, the 5-year total shareholder return stands at 12%. Okay, I was reading somewhere that even I think Sandabi sort of performed slightly better than the S&P 500. I think S&P 500 averaged to 10%, if I'm not mistaken. Okay, so I believe Sandabi is a solid company. Okay, investing in Malaysia's future, and I believe we investing in it will be a good long-term investment. All
So
right.
this 12% is the EPS, earnings per share. So
Mhm.
total earnings divided by number of shares. So this EPS, earnings per share. Okay.
Okay. Okay.
Thank you.
All right.
Thank you, Darren,
Thank
for your
you.
wrap up.
All right.
Thank you.
So that's all, Emily.
Yes, that's all.
Okay. Okay, thank you so much, group, for your presentation.
Thank you
Yes,
so
it
much.
was detailed with a case study. Yes, that surely gave us some insight. So some practical exposure of particular Malaysian company. So they actually later go with expansion and yeah. So the group highlighted the EPS and DPS, dividend per share, or something like that. Yes. Yeah, the thing is that you see, first there was a cash dividend, and we mentioned that if a particular company has their fund shortage, there is a liquidity crisis or something like that, that is not only the reason. If they have some expansion plan, that the group just immediately just they mentioned that if they have some attractive proposal for the expansion of the product, services, branches, or like that, in that case, company can use this share dividend. You see, if it is a only fund crisis, then that is different issue. That has some signaling effect, negative signaling. But if it is for, if companies are able to understand their investor that they are using share dividend because they are going for the expansion. So that means if they have a dividend 10%, 6% right now, in next year their dividend growth would be 7 or something like that. So if companies are able to understand people, their sentiment that this is for the expansion, so this will be a positive signal to the market that yes, the company will provide better dividend or company will go for their expansion. So this is itself a good news for the shareholders. So people will buy more share this company because this indicates a particular growth of the company. But if it is for because of the cash shortage, that has negative. So it has both negative and positive impact in the market. But this is an option, you see, in every time, individually, or if you think about the organizational perspective, so there might not have sufficient cash because may have expansion plan, may have shortage of funds. So this is very usual in business. In some days you will have huge cash liquidity, it is called over liquid, sometimes shortage of liquidity. So both are actually danger for the company because if you are a company, then you must balance between your liquid condition. So if it is more liquid, that means your profitable would be lower. If you are with shortage of your liquidity, then there would be a customer relationship problem. Like if shareholder understand that company are not giving dividends or any benefit, that means they will not buy the share in the market. So that is why again it will backfire, that company share price will go down and company may lose their trust in the market. So yes, it has both impact, but this is one of the options. So if company give cash dividend, that is fine. But if company can use another option like share dividend, so how it would be distributed? Like you see, if you have two share, then if it is declared that there would be one share, 2:1. That means if you have two share, it would be at the end it would be 3 because there would be extra one share given. Maybe it is 2.0, that is 2 is 2.5. That means if you have two share, then you will get a half share. So like that, if you have four share, you will get one. So it would be altogether 5. So there could be different way. Uh, yes, there are some danger also. You see that exactly group mentioned that dilution of the share value. You see, if you distribute more share in the market, so what is earnings per share? If you have 100 earnings and your share is, you see, 1000, it is 0.1. That means if you divide in that way, so that would be like 0.1. So if you distribute more share, then your share would be like something 1500, 1200. That is number of share is increasing, but your earnings become the same. In that case, your EPS would be lower. So how a particular investor think about buying a particular share? They have some of the criteria like EPS, DPS, dividend per share, earnings per share, price earning ratio, company's growth, company's prospects. So these are the different analysis, that is fundamental analysis, technical analysis, and based on that, the individual investor invest in particular share. So if they find that their EPS is down than the previous year, so they can, this could be a negative one. But again, if they find that the reason is that just because of the share dividend, so maybe they can understand that for the future growth. Again, it depends who actually accept in how and in whose way. You see, if your investor is institutional investor, I'm talking about, yes, institutional investor. That means all the banks, non-bank, different non-financial institution, different company. Because you are a company, again, you if you have additional amount, you will not keep it idle. You need to invest it somewhere. So that means you are also an investor in the stock market. So in that case, institutional investor has their ability, they have their liquidity, they have their solvency. So that is why they need not to have immediate cash or something like that. So they invest for 5 years, 10 years. So instead of investing in bank for FDR, fixed deposit receipt, they invest in stock market for 5 years, so for the long term. So in between this 5 year, whether they receive interest, sorry, dividend or not, or bonus share or not, that is not their consideration because they are solvent people. But you will find there are some people like retired army officials, maybe retired grandma. They need every year some sort of cash to expense their life. So for spending different uh, expenses, maybe some of the people, maybe the students, maybe housewife, maybe you see, unemployed people, so they need immediate cash. So that is why, yes, in the group one they mentioned that it is a good option, that it has also some signal to the people, they need urgent money. But if we consider institutional investor, in that case, they can also accept for the share. So yes, both this has some impact, positive and negative impact. The question is how you are using this one, in which context, and how you make thing understand to your shareholder that this is the purpose behind we are distributing cash or we are distributing share. Okay, so both has strong point and they have some weaknesses also, but it depends upon the purpose of use. As I mentioned that dividend is relevant, some scholar found that dividend is irrelevant because it is also true. Empirically, it is true that from different research, it is found that if you distribute dividend, then that company's share would be go up. But if company has a shortage of that, the same decision of distributing share dividend has a negative impact in the market, because if they feel that company has shortage of cash and company is going down, there is another perspective we can discuss, that yes, if you do not distribute any cash dividend, any stock dividend, or split or something like that, if you do not consider anything, then your company may be categorized in A, it would be in Z category. In every year, the stock market be listed out, okay, listed out that the position of the company, their performances, and if your company is tagged with Z category share because you didn't distribute any dividend or something like that, so in that case, it would be a disaster for the company. So that is why this chapter name is dividend policy. So that means how you will decide that your company should pay how much dividend, not only whether you should go for dividend or something not. This chapter is like that. We can assess that yes, if you distribute in different way with different options, then your share value, your company value may be maximized, minimized, or maybe in different conditions. So there are so many maths, there are so many empirical evidence from market research have been done that yes, dividend is somewhat relevant, in some cases irrelevant. I'm giving you one example of dividend irrelevant. If you find that there are some companies that do not give any dividend, even in any stock dividend or something like that. Company like IBM, so Bill Gates company. So I have heard that yes, I found also some somewhere that they do not give any dividend to the shareholder. But still, why this company share value is price is so high? Because they do not give any dividend. You see, we already mentioned that dividend is on one of the consideration. So whether it is cash, whether it is share, that is in terms of share, but there is all another way is capital gain. If you buy today and if you sell it after 3 days, so that is also a consideration. If your company is progressive with good policy, with stable policy, and if you IBM can show IBM showed that they have stable policy. Windows one after one, Windows, mobile phone, even yeah, different. Uh, they have different products also. So they are very relevant last. So I have seen last 20 years, IBM have been a relevant company, still in the top 10 company in the world. So that is why even people can consider that one as a consideration instead of you see the dividend or share. So if your company is able to understand public that you are going for the betterment of the shareholder, that is your decision is rising the share price value, it is increasing the share value, in that case people will also understand. So that is the third angle I am talking about, giving dividend, giving you see some sort of stock or dividend, or even you can go without dividend, but how you are going, that is actually dividend policy. That is the subject matter of this chapter. I think we have only few minutes left, so maybe we will not able to cover the other two, but we can just highlight some of the issue. So can anyone from the group of share repurchase just give the definition of share repurchase so that we can just conclude this one? Later we can go with the math or some other in physical classes or something. Anyone? Share repurchase. The another option is share repurchase.
Doctor, actually, I did it for share dividend, but I can talk regarding to share repurchase.
Okay, welcome. Most welcome, please.
Okay, so for share repurchase, it's also called share payback when a company buys back its own share from the market or from direct shareholders.
So
So
why company will buy back their own share? Why? Question is why?
uh, in order to reduce the number of outstanding shares, increase the earning per
Okay,
share,
that is good. That is one. Okay. So
uh,
that means they have
uh, to
51% share. So now 49% is outstanding. So in that case, companies sometimes rebuy their share to increase their outstanding, their own share. That means it could be 60% of their ownership of their share.
Ye-
This is one of the reason. Yes. Another one.
Yes.
Another one.
They can increase earning per share. Sometimes they
Yes.
back
Good.
repurchase the share and cancel it.
Okay. So EPS, that means the earnings divided by number of shares. So if you can decrease outstanding share, then your EPS would be high.
Exactly. Yes.
So that is the second
Yes.
reason. There is another reason that, yeah, can you just tell me the another
Uh,
reason?
to support or increase the stock price.
Okay, that is, yeah, ultimately that is also EPS is related with the price. The thing is that in some cases, company becomes or fall in false position, like you say, they may have downward demand of their share. So share price going down and down. So in that case, company want to reassure or want to establish a trust among the shareholder that we are buying back. So this is one sort of guarantee that yes, if it is needed, we will buy our own share. So that means they are giving a sort of guarantee. So this can help to boosting up their share price or something like that. So in emergency, company may buy back their own share. It is indicating that yes, market has some sort of demand. If nobody is there, we are going to buy that one. Exactly. Okay. So the next one is actually the share split, although it is not directly related to the dividend or giving distributing any sort of benefit, but still it has some of the benefit to the shareholders point of view. So anyone with the share split, just give a definition only. If not, I am explaining. Share split is meaning that, oh, okay, please.
Okay. My group we doing share split. So basically, share split is just splitting a big one share into a multiple shares lah.
Yes.
So it's not a dividend per se. It's just splitting a bigger share into the smaller share, and is expressed in ratio instead of
Right.
percentage.
So we know that there is a lot. If it is a five share lot, then suppose if it is 10 ringgit, then it would be 50 ringgit. Just think about if the number of share per share is 100, then five share equivalent to 500 ringgit. So in many cases that if it is individual investor like a student or young people, millennium people or generation Z, you see, they may not have that sort of money. So that is why they are unable to buy a big lot share if the lot is like 5,000 per lot. So it is difficult to purchase for many of the investors. So that is why if you just split it into five share, there was one share, one lot. Now you can, if you split it as a, you see five, that is five different share with the lowest of, if you divide with the face value. So if it is 50 divided by 5, so it is 10 ringgit only per sharing per share. So it helps to boost to increase your demand, because if you increase the total lot value or even share price, so that is difficult for many investor. I'm talking about individual investor, not the institutional investor. So in that case, yes, it is also helpful for increasing your demand. So it is also considered as a benefit. So since this chapter is dividend policy, that how you can integrate this different policy so that your share value is maximum and it is benefit, it ensure benefit to the your shareholders. Okay. So there are some other mode also we didn't discuss. I'm taking just 1 or 2 minutes. Like you see, there is a right share, bonus share, and there is a right share. Bonus share dividend is almost set, but there is a right share. So do you know anyone the right share? Any idea about right share? Okay, since we have only few minutes,
No.
right share is like you see, uh, you have the right because you are existing shareholder. So anything new benefit proposing to the public, before that you should propose this share to purchase from your existing shareholder. So that is why it is called right share. This word comes from there is a preemption right. Okay. So if you have land beside your house, if you want to sell that one, you should offer to your neighbors first because they are your immediate neighbor and they have their right. So that is why preemption right is a lawful action. A law is a law for every country, although it is not written in that way, but from the ethical perspective of view, you must offer your neighbors. So like that, company if company offers any new share with their face value, that means market value is high. If face value is 10 ringgit, market share price is 100. So definitely, if you buy with face value of any share, you can gain because if you just sell it to the 3 days, you can gain it like 80 ringgit or something. So there will be huge profit or something. So that is why companies ethical point of view, company should offer their existing shareholder. But this is not a free. You must deposit the face value equivalent price. That means it is giving, that is company is selling their share, new share in discount or in face value. So that is the benefit. So that is also called right share. So this is also considered as your benefit also. Okay. So this is how that we have known there are different way of we can say that distributing profit to the shareholders, and it has some of the impact to the market and in the market price. I think we could not cover some of the issues like what are the impact, like if there is a stock shipment, that means stock dividend or cash dividend, how it impact to the share price. We have some of the math like you see the share repurchase or splitting, and we can show some of the mathematical impact. I think next class will be physical. I will try to cover, but again, uh, yeah, this is important, but maybe it is not that important because there is no final exam. So it's okay. I think we can cover. Those who will be in class, they can go with the math, but I will try to give you some sort of solution of the math or so that you can just follow. Because in your lecture, if you follow that, the solution is also given here. Okay, so that will help. So I'm sharing it quickly. So there are some impact you can see that we can discuss in next class. And we have another one chapter only remaining. So we are in good pace. So there will be no issue. If we can finish all the chapters earlier, then we will go with some of the revision or something like that. Okay. But another issue I want to discuss is that uh, today, whenever we check the assignment one is not submitted by all the groups. Maybe there is one group that didn't submit. Is there anyone who didn't submit assignment one? I'm talking about assignment one because today is the last date. You see, Sunday, even it is Sunday, I need to go to campus and I need to input the marks. So because I'm waiting at the very last. So yes, 3 p.m. was the last time. So if we do not receive assignment, then we should go for marking. Okay. So we are waiting. Still, if you have, you can submit. You can talk to Dr. Rabia and we can finish. I think that's all. Thank you so much for your presence, for your lively presentation. You got very less time. 1 hour is not sufficient to prepare that one, but my purpose was you so that you can learn how to prepare infograph with your innovation, and yeah, you will present the class and I will just integrate things, okay, like that. So for your information, you can prepare infograph by using notebook LM, okay, or there are some AI you can also use. There is no harm with using that one. Someone or some of you use maybe AI, maybe you personally prepare, that is not the issue. If you use the notebook LM, if you just upload your slides or something like some of the information, then it will prepare you a very good, actually, we can call that infographic. Okay. So that was my purpose, so that you learn how to prepare infographic. Okay. So thank you so much. I think no need to extend this session. Thank you so much for your active and informative. presentation, sharing, everything. Okay, so anything, and you have anything?
Sir,
Yes,
attendance.
doctor.
Attendance you will find in Google
For
Classroom. In Google Classroom, I added, you see the QR code. Did you get that one?
Yeah,
yes, yes,
we
Yes,
we
we
have
already there.
already.
Oh, yes.
it's in the GC.
Mohammed, you want to ask anything? Because I didn't see
Yes,
many of you is very unfamiliar face because I used to take physical class, so I do not have any interaction with you. It was very
yes.
my pleasure that we are meeting some of. Oh, yeah.